This is Rob Roy of VEEV Options, and welcome to TradeFinder Live. For those of you that are new with us this evening, we have to go through this wonderful, and even for those of you that have been with us each and every week, we go through this disclosure/disclaimer. If you are new, please take a screenshot of it, read it in detail in your leisure, just to highlight a couple things that the powers that be want us to impart to you is that, number one, we are not registered to give individual investment advice in the United States. And any pricing that was talked about, because we have a lot of international viewers, we have a lot of international subscribers, any pricing that we talked about is assumed to be in US dollars unless denoted otherwise. So those are the two primary things they want you to know, but take a look at the rest of it when you get a chance. So with that said, let's go ahead and take a look at the current market. Here we are. Here's the chart of the S&P. Note today, basically all we did was close the gap. Posted a note to our subscribers on our website. For our subscribers, each and every week we do a live webinar where we discuss all of the alerts that are in our portfolios, both the impulse and the volatility portfolios, and it's interactive so that our subscribers can ask questions directly about the strategies, etc., and any individual alerts that they may have questions for. We want to spur the understanding and the education as well. But in the meantime, between the week or so, in between the webinars, if there's a special note that feel like something specific happened today in the trading and want them to be aware of, then there's a place where I can put written commentary for the subscribers as well. And that was the thing that we noted that, let's go back, put the Elliott wave on here, and we can see where this corrective level is. And I'm going to go through that again because that was a question somebody asked as to how to do the fib corrective lines. So you can see that we came down, and yesterday we came down, tapped this 61% fib corrective retracement level, and then also this zigzag pattern has just potentially a little bit more to go. But the fact that we've come to this 61.8% corrective level was a likely point of support, and look for maybe a bounce from this point, which is exactly what happened. And then I'm going to take this stuff off and go back to the 10-day moving average, and you can see that we walked this back. Another cool thing about ProfitSource is the fact that you can go back. This is a really good educational part of the software, is that you can go back, click anywhere, just pick any chart and walk back. Just, like close your eyes, picking a spot on a map, whatever, close your eyes, click on a bar and look at the pattern, see where it is, and say, okay, if I was looking at this pattern today, where do I think things would go? Do your analysis, do your forecasting, do your things that we teach you about Elliott wave and Fibonacci corrections and extensions, and then push the chart forward and see where it wound up. It's a great thing to do educationally wise. So here's the 10-day moving average. And so the other note part of it was, not only did we hit the 61.8% corrective level down here, look, that was the low of the bar, and then we closed on the high. But you can see at the low of the day, from where the 10-day moving average is, which is the lime green line, starting to get some separation. Now, if you're fairly new with us, I haven't said it in a week or two just to give you a break, but those of you that have been with us for a while, you've heard me say it numerous times. You're going to hear me say it numerous more times. No security in any time frame is very far away from the 10-day moving average. It does not happen. That's a rule. We talk a lot with Elliott wave on rules versus guidelines, and that's a rule. Nothing is very far away from the 10-day moving average. So when you start to see some separation there, we were getting oversold on the low, so we rebounded up here and mentioned that, hey, we may churn a bit, and to close that gap with the 10-day moving average, and then boom, we bounced right back today, close that gap, move back up. The high of the day still didn't move back above the 50-day moving average. But on the other hand, what we have to also respect, and that's the beauty of Elliott wave, is the fact that if one pattern becomes disqualified or one pattern doesn't work, think if you were just one-sided, if you just had one directional move in mind, and you just focused on that, and you were convinced that you were going to be right, that move was going to happen, and then it didn't. Well, what would you do? you're going to be lost. So with Elliott wave, you know that, okay, if that pattern doesn't work, this pattern now is qualified. That's what's happening. There's no indecision point. Instantly, you know what the next move is. So there's no point of, what do I do now? Or, gee, that didn't work. What, do I just take the loss and move on? So that's why we do a lot of adjustments with Elliott wave options, is because we know what the next pattern is. So this current pattern here doesn't have much more to go to the downside. This is zigzag. However, we still have a move here with that 61.8% level. Don't forget that that is a qualified zigzag pattern that could potentially resolve itself to the upside. Now, I think that that is less likely to happen, but you can't discount any pattern that is currently qualified. So there's a qualified downward zigzag that's almost complete. It's nearly to its end. And then there's still an upward zigzag that has potential. Now, if this corrective move comes down, so it's right at 61.8, if it comes down to 70%, then that nullifies this. That's one of Elliott's rules. I kind of would let it go all the way to 78.6, but Elliott was more like, oh, if you hit 70%, then it's probably disqualified. So it's still in play and it's still qualified. So we had a little bit of a bounce today. I still stand by what I said yesterday, that I just think that was an oversold bounce, churning a bit. I wouldn't be surprised if we go sideways a little bit more. You can see all of this stuff that occurred through here when we got here last time, way back in the beginning of June, where we hit that pattern, bounced down, came back, became resistance, then support. This is such a good example of old, in this case, old resistance becomes new support. Old support becomes new resistance. It works both ways. But now we're right back to that level. We bounced off of it. We were oversold. We bounced off of it. We had a gap. We closed the gap. Everything that's happened over the last 2 days has made perfect sense from an Elliott wave Fibonacci standpoint. No indecision whatsoever on what's going on. Now what we find out, or what we look to find out, is do we drift back down and complete that pattern to the downside? Or is that it, the 61.8% corrective level on this larger zigzag, and we have an extended wave 5 to this big 5, and we go up here towards that 100% extension level? So that's what we have to look to find out. That's where the market is. And currently we have puts on the SPY because that's the current primary pattern. But if it changes or satisfies itself, obviously, then you get out of the puts. And then you watch to see if that could be an extended leg as well. Remember that just because it comes to the 100% extension doesn't mean that has to be the end of the move. We have extended moves all the time. We could easily come all the way down here. That's why when you hear the adage, trade what the market gives you, don't trade what you think. I've talked about this before as well, and I think it's just extremely important. It was a lesson I learned. I mentioned it, I believe, last week, but I mentioned it in a recent webinar, that one of the difficult things for me early in my trading career was realizing that the more I learned about the underlying workings of fundamentals, etc., stocks, stuff like that, market, the more I thought I knew what I was doing. So the more I thought I was learning, the more dangerous I was becoming, because I began to trade what I thought was going to happen. This is what the market should do based on Rob Roy's brain, and what I've learned, and would be flabbergasted that the market wasn't doing what I thought it should be doing. And that's just flat out ego. That's all that is. That's you thinking you're smarter than the market. And as soon as you get to that point, you're in deep trouble, because nobody is. Nobody's smarter than the market. So it took a few painful lessons to realize, hey, the market's the boss. It just is. Let's trade what the market's telling us. And there's plenty of times when what the market's doing makes absolutely no sense to you. None whatsoever. Like, I cannot fundamentally justify in my brain why the market's doing this. But in the end, does it matter? Why drive yourself crazy worrying about that stuff? It doesn't matter. trade what the market's showing you. That's all that matters. Put on trades based on what the market's doing so you can make profitable trades and generate income and a living versus trying to figure out why it's doing something that makes no sense to you and losing money in the meantime or missing opportunities in the meantime. It's a big important deal. So, you know, the people that complain about, oh, you got more than one Elliott pattern, well, you're going to be right. Well, I don't care about being right. It doesn't matter to me if I label the patterns exactly the right way. What I want to do is try to generate as many profitable trading opportunities for our subscribers as we can. That's the only goal that I have in doing this. It's the only reason I'm doing this. I mean, there's other things I could do with my time, but this is what I want to do because, you know, there's so many foo-foo-y people out there that don't care about the average person. Anyway, all right, so one other thing that I wanted to share with you is this is an educational program that we've been working on for our subscribers, and we're about to release it. So I thought I'd give you a snippet of it. It was in the last S&P update video, so if you watch that, bear with me, you've seen this before. But if you haven't seen that video yet, I just wanted to show this to you. I'm going to show you just a touch more detail than what we did in the YouTube video dealing with the market, but it's on diagonals, a pattern that Elliott really liked, and it's a pattern that just isn't talked about very often in the Elliott wave world. It's not an impulse pattern. There are similarities and differences to the impulse pattern. Elliott would term them diagonal triangles, which is a difference between, there's a difference between a diagonal triangle and a corrective triangle. So in order to alleviate confusion with our subscribers, we're just calling them diagonals and keeping the corrective triangles in our volatility strategy. But the similarities are there are 5 waves. The differences are there's no mono waves. Everything is complex. Every single wave is complex. Now, when you take a look at this, you're thinking, okay, because there's 2 types of diagonals, leading and ending. And you're looking at this, okay, wave 5 went to 38%. That's where we ran into some resistance, the fib level. It's the wave 5 in this diagonal pattern. And those of you that like to trade short term, this is a pattern that you really want to get behind. If you like trading currencies, if you like trading futures, even if you're, which I still am nervous about, the Robinhood guys where you're trading the single dollar stocks, the high momentum stuff, this is a pattern for shorter term traders to really wrap their heads around, because look at all that stuff that's going on within those waves. There's so many potential trades that are within there. It doesn't mean you have to break it down into these degrees and trade short term. You don't have to, but you can. So watch for that program to come out and take advantage of learning this pattern, especially if you like trading a bit more in the short term. So when you look at this, it appears that it's an ending pattern, but it continued on, and actually it's a leading diagonal pattern. And one of the rules is those lines will eventually cross, and they have to cross after the 5 completes. Well, it didn't, right? They kept going. And so then you look at a whole different scenario. That was a leading diagonal in the wave 1. Then we have our complex 2, our complex 3, 4, and 5. And then you get the blow off top. And that is a designation of an ending diagonal. That FOMO, fear of missing out, when everybody's like, oh man, the market just keeps going up and I'm missing out. All these people making all this money and I'm missing out, all that stuff that you hear. And you get that blow off top. That's when, boom, the corrective move is ready to start. That's exactly where we are in the market right now. That's the current chart. So it's just a perfect example. I mean, the timing of us putting this educational course together couldn't have been better. So I just wanted to highlight that for you. And so back to market and where we are right now, there we are. So that is about as current as it gets. And so this blow off top was an ending diagonal pattern. And you can clearly see here what I just showed you. There's the pattern right there. That was the 5 waves. And they ended. And then that blow off top, it was a vertical move. And how many times have you heard me talk about the difference between a 45-degree angle move versus a more vertical move? And the more vertical moves have more volatile corrections. I know you've heard me talk about that over the last several weeks if you've been on any of these recordings, and all that ties in with where we are right now. So my point, and what I wanted to really share with you this evening, is what's occurred in the market over the past couple of weeks couldn't be any more classic Elliott wave Fibonacci levels. I mean, it's been spot on as spot on can be. We are in a period of, all right, are we going to complete that downward zigzag? Then what happens? Does that 61.8% level hold? That's the two questions. And the market's going to give us the answer. So we don't have to really look to figure it out. So with puts on the S&P, if it goes down, great. If it starts to bounce, then you make an adjustment. We still have long positions on as well. In fact, I wanted to go to the website now and revisit, when we talked about this before, but I want to revisit this one, which is the alert that we have on Nike. So taking a look at Nike, where we sent out the original butterfly, out of money butterfly, which you guys have asked so many questions about, where we make the butterfly directional by placing it out of the money, using Elliott wave to determine where we're going to go, because the primary question when you're placing an out of the money butterfly is where are the wings going to be? Where do you put the strikes? How do you set up the butterfly? How do you know where to put it? All those things are governed around where you expect the stock to go. So we use Elliott wave. We just follow our Elliott wave patterns on where's the stock expected to go. Great, boom, let's set a butterfly around that area. So in this case, we had that little triangle. We bounced out of it, just a tiny triangle, right up to the 38% fib extension level. And we were expecting a continuation based on the DMI. Remember, we utilize the DMI to help us, because you never know when, if you just looked at the Fibonacci extension levels and the Elliott wave, there are times when the pattern does what it's supposed to do and you're at a point of a fib resistance. Is it going to extend? Is it done, or is it going to extend? That's where we use our confirming indicators to help us have a little bit of an edge of, all right, the likelihood is that that's going to be an extended C wave, that it's not done. It could be finished and it could follow all the rules and be completely done, or it may go through an extension leg. And based on the DMI, that helps us to know. And so the expectation was, because there's a very strong looking DMI, that that was going to continue. So the next 61.8% fib level is at 120. All right, there you go. That's the midpoint of your butterfly. It's as simple as that. We buy the protection around it, buy a lower strike from the 120, buy higher strike. So we bought 115, we bought 125, and sold two 120s in the middle, and we did that 6 times. That was the initial alert that went out. That's how it was set up, and it's just, that's how it works. So we based those out of the money butterflies around Elliott wave, and it was 55 cents a contract to get in. Super cheap. That's the beauty of, but you got a 10-point wide butterfly for 55 cents. That means a lot of profit, a lot of potential profit if you can get that stock in those wings, close to the mid strike, close to expiration. Then you can have, I don't know what baseball, you use a grand slam all the time, but whatever would be better than a grand slam, inside the park, home run, whatever. But so 55 cents to get in. And then Nike moved up and it hit its target price right at 120, right at that 61.8% level. It's time to get out. Well, you look at this and say, okay, it's an October position. There's still a lot of time, because the exit alert that we sent out, as you can see, was on September 11th. So September 11th is a far cry from October expiration. So there's a lot of time left to go. So the temptation would be, well, let's just let it sit there. So let's sit there for a while, see if it churns back and forth in that area. Every day that goes by, time decay is working in our favor. But what if it moves out of the wings? Right now, you could sell it at 78 cents and take a gain. I did see some fills go through there at 84, I mentioned, but we left the our fill at 78 because that was what we got. So looking at that, there's 5 contracts at 78 cents. Remember, we entered 6, So that still gave us a nice return on the position. And now we still have room to go. We still have potential room for it to move with the one remaining contract. And just like with our general commentary on the market, here posted a comment for our subscribers explaining what was going on by leaving that extra position. So in between the weekly webinars, posted a note, so they're like, people wonder, like, wait a minute, we had 6, you only closed 5. You know, everybody's like, did you make a mistake? And, you know, fair question. No, here's the explanation. Here's what we're doing. We're purposely leaving one because Nike was moving into an earnings report, and the earnings report was today. The earnings report was after hours today. And the stock right now at this moment is trading at 132. So it popped up on earnings. They beat earnings. So it's right now at this point, it's out of the wings of the butterfly. But the implied volatility that they hold, with 120 being the midpoint at the time that we exited on the 11th, that's where the greatest amount of extrinsic value is. And they're going to hold all that extrinsic value into earnings. And then when the earnings report comes out, like a vacuum, all that implied volatility gets sucked out of the options. So now that gives it the opportunity, because that's where the profit comes, right? You're taking away all the premium from the options you sold. That's where your profit comes from. The 2 wings that you're buying, yeah, they generate profit too, but they're mainly there for protection. The biggest part of the money comes from sucking out the premium in the 2 options that you're selling. So when the implied volatility drops, now we have the opportunity to have this one remaining contract. If the stock drifts back down, and I think there's a good chance of that happening, it doesn't have to happen tomorrow. We have all the way till October expiration now for Nike to drift back down. It's going to gap up if everything holds into the open, which it looks like it probably will. It's going to gap up in the morning, and then over the next few days, what normally happens, especially in this market, which is not super bullish at the moment, it's likely to drift back down. If that comes back down within the wings of our butterfly, now all of a sudden we can generate a really nice gain in the remaining contract. We sell that one, we close it out, and it boosts up the return that we already have that's guaranteed locked in, even if that last contract expires worthless. Let's say Nike blows through tomorrow, blows out of our butterfly, just runs like a scalded rabbit, never comes back down, and that option just expires worthless. No worries, we still have the 43% locked in. That's done. That's the worst thing that we can do. So it's a interesting and prudent thing to do. So I wanted to revisit this one because this was the reason that we held the contract. Was the extra contract was for the earnings report, and the earnings report happened after hours today. So the other one that I wanted to show you, because we didn't close anything this week with the market, is I wanted to show you and walk you through the newest one that we sent out. So we sent out a new alert today, and that's on Sony, SNE. So as you can see, it's in the volatility strategy, which is a really good place to be, especially when you're in this in-between. Where's the market going to go from here? Remember, we already have the puts on the SPY, so the downside's covered if we continue lower, whatever. And once we get the next signal of the clear signal on the next impulsive move, then we can put that. Look, we're already up 8% just on what happened from the time that we placed it today to the close. So that's pretty cool. But when you look at this, here's the chart, and this one was really neat. So it just completed a zigzag pattern here, and you can clearly see I didn't draw this little triangle here in May. Look at that little triangle right there to the 0 point. Are you starting to see these things? I hope so. That's my goal. My main goal for doing this kind of stuff is that when you look at a chart, you see it differently than you did before you started interacting with Elliott Wave options. That you used to look at a chart and see a bunch of bars on there. Maybe you didn't see the patterns the way you're starting to see them now. And in the future, when you look at a chart, these type of patterns just jump off at you. I used to use the analogy when I was doing live seminars, and everything's online now. When I was doing live seminars, I would talk about, when you go into like a Spencer's Gifts or whatever, and they have those posters, and it looks like it's just a whole bunch of hieroglyphics at first blush. But then when you stare at it for a long time, some weird thing happens with your eyes, and then there's a pattern that emerges. from it. You know the posters I'm talking about? I haven't seen so many of them lately, but you know, when we were growing up, they used to be all over the place. So you first look at it and it just looks like a jumbled mess. You stare at it and then an image or a pattern starts to come out to you. And that's what I want these charts to look like for you. That when you see the chart, all of a sudden the patterns become clear. So there's that little triangle. Then we started this zigzag pattern. It completed. And this is the reason that this one's what caused this one to become an alert, because there's 170 something consolidating patterns right now. Some of them are very good. The majority of them aren't very good. The majority of them are dead sideways. That's the last thing we want in the volatility portfolio, is a dead sideways pattern, because those can keep going sideways. The triangles tend to break out. So we have the completion of the zigzag and then went right into a consolidating triangle. And then looking at the ADX here, it's down just even a touch below 12. We get really interested when the ADX drops below 15, really interested when it drops below 13. That's normally when you're getting pretty close to the breakout point. So down just a hair under 12 was good. So that was the reasoning for this. But it also was an example of, hopefully you could see that. You saw this little triangle, you see the zigzag, and then you can see the consolidating triangle here, a much larger one than that little one there in May. But anyway, I hope you get to that point if you haven't already. But it was a December, and the stock's trading at just under 79, which is kind of in the midpoint between the 90 and 70. Like normally people would think 90, 70, yeah, 90, 70 strangle with the stock at 80. That stock's not going to move that much. It's not going to move above 90 or below 70. Remember, it doesn't have to. We don't care if it ever gets to 90 or ever gets to 70. It doesn't need to for us to generate a gain. We're trading the delta to one direction and the delta to the other direction. That's what we're trading. The difference is in the delta on any movement in the stock. Option doesn't have to move in the money for the position to make money. So I wanted to share that one with you as far as our exercise from the website. All right, back to the charts. We're going to take a look at our most recent case studies. Now remember, we were talking last week about how a couple of the corrective patterns weren't really cooperating, and we wanted to see where they were going to go from here. Well, back on the 1st, we had MTOR. Well, that one, remember we had this little triangle that we talked about last week, right here, this little consolidation here, and we said we were going to see how the next day moved. Well, it started to the downside. So last week we break down, and so we've come down and closed this gap right there. And so closing that gap yesterday, bounced back a little bit today. Putting the moving averages on, you can see we're also just a bit oversold on this one. Still with the target of the previous 4 as the eventual move, but we've now moved from, we were, around $1. It had moved down around $1 from the time that we looked at it on the 1st, and now we're down to where it's $3 or $4 down on a $20 stock. So that's a 15% move. So how greedy do you want to be? That's what you have to decide, is your own risk management. We send out alerts for our subscribers on closing positions, but in the TradeFinder, you have to figure them out for yourself if you're following along with these. So that's something I wanted to show you. Then last week's was Texas Instrument, or 2 weeks ago was Texas Instruments, and that one's really not following along with what MTOR did. It's still just channeling here. We talked about the potential of maybe an adjustment last week with this one, but it's just churning here in between. Looking at the moving averages, it's just trading right around all 3 of them, the 10, 30, and 50. It's all right in the middle of all of them. So not a whole lot going on with Texas Instruments yet. We'd like to see that one move more like the MTOR one, but so far it's just churning. So let's see where we were on the 8th. 136, and we're 138, so it's actually up. Remember, we were boom, boom, boom to the downside. We've even talked about that we were a little bit oversold, but it was a good pattern at the time. And so now we've corrected that oversold condition. We're a couple dollars higher than where we first looked at it. It's not really a great looking triangle formation. It's just kind of churning here. It's not even really a very good looking flat. It's just moving sideways. And at some point in time, I think some pattern will begin to come clear on what's happening there. And then last week, and the one we looked at, pardon me, was CBRE, and it's difficult to put on. It's not impossible, but it's difficult to put on new bullish trades with a market like this and put on the S&P 500 update a couple weeks ago, and we talked about this even in this class, even in the TradeFinder. Be careful of putting on new bullish positions. But we did look at this one last week, and it looked potentially pretty good if we go back to where we were last week. So there was the pattern, and clearly we can see this zigzag here, and the potential to move higher. The DMI looks pretty good, and next day was good. Then we had the move down, and then the drop yesterday, sideways move today. From a technical standpoint, purely technical standpoint, as long as this B segment holds, that point holds, you can stay in. If that's violated, then that's your exit or adjustment part. Now we have this gap here, so we'll see if it comes back to the upside and takes that out. But just one that we wanted to follow and see what happens. But obviously, that was the reason that was not sent out as an alert to our subscribers. It's just when you have a qualified downward zigzag in the S&P 500, putting on new bullish positions is something to be careful of, to say the least. But that's what we did. That's where we were. And now we'll go ahead and take a look at any potential new case studies to look at this week. See, there's the consolidating stocks, 89 of them. So several have dropped off. There was a lot more than that over the past couple of days. So with today's update, we have fewer. We actually have a couple of impulse ones. Let's look at those first, just out of curiosity. They're both children's clothes. Isn't that interesting? Carter's and Children's Place. Both dealing with children's clothes. So this is when that becomes interesting, because especially when I've talked about the money rotation, where it doesn't seem like the Federal Reserve is pumping as much money into the system as they once were. So money is rotating around. You can see it, and it's moving quick. It's amazing to me, because rotation in the markets has always been there. That's nothing new. It always occurs. But how fast the rotation occurs now is one of the things that's been interesting to me to see. It comes in, it'll hover around the sector and be involved in a few stocks within the sector for a couple days, and then it's gone. It's crazy. So here's Carter's, and we'll take all this stuff off. Put the Elliott wave on, and it's just in a bunch of corrective patterns. So these are all flats through here, and this is what most people would say trading range. Most people would see the highs and the lows with the trading range, but those are all flats. There's actually a zigzag there. Look at that in the A wave of that flat, A, B, C. So these two are mono-ish, but that's a zigzag here. Boom, look at that, 100% extension, dead on it. All right, so looking at the sideways movement here, there's nothing here that interests me as far as this area right here. Let's take a look at Children's Place, which is an actual clothing store. I think Carter's actually has some stores now too, but Children's Place is a children's apparel store. It's a decent looking DMI. It's just coming from the completion of the downward move. The ADX never got below 20. I know this is not a super big deal because a lot of people look at 25 as the level, but I prefer it when the ADX makes it below 20 before it starts to curl back up. Just didn't quite make it back up that far. That just means, that makes me question, is this a potential sustained move, or is it more of just a bounce and it's not going to follow through and continue to the upside? Because you can see right now all we have is an impulse right here. There's nothing to base any sort of extended move there in this super tiny triangle right here. A couple dollars wide, so it's going to move a couple of dollars here within the next day or two, but other than that, I don't see a whole lot there. And this makes more sense as far as the potential for a downward move. It's just, you have to respect the fact that the DMI is showing, you know, there really are some legit buyers in here. And to me, the whole children's clothing thing, it's not, when you talk to people, it's not really listed as a defensive area, but the thought process with the money rotation for those that really focus on fundamentals is begins to look at, if the economy is going to stay troubled with this virus thing for an extended period, what are the things that people are going to buy no matter what? So the normal defensive areas are tobacco, alcohol, and gambling. Those are the three ones that people normally look at, because people are going to drink, smoke, and gamble no matter what's going on in the world. That's, now you can, I'm not, you know, you can argue and say, I don't believe that or whatever. That's been the pervasive thought in the markets. That's where money moves when you have a challenging time, because that's just what people think. Now, whether or not it actually works that way or not, again, doesn't matter. That's what people think. That's where the money goes. Those are the stocks that outperform when you have a bearish primary market of like the S&P and the Dow. So the DMI is leading us to believe that this could break higher from here, maybe violate this wave 4 and move to the upside. That's a pretty good Elliott wave pattern to the downside if you weren't looking at the DMI. So for me, this is too much of a dichotomy. So this is just that'd be interesting to watch and see what happens, but it's a no-go as far as any sort of position. I like that little triangle there, but that's not enough movement to even put on one of our triangles. It's just not worth it. So interesting pattern, and I'm actually going to make a note of that one just out of curiosity to see which way it goes. So it's PLCE. Again, I don't think you have the clarity issue that we had now that we're using Zoom for these, but the symbol is PLCE. Just nothing more than interesting to keep an eye on it and see what happens. All right, so let's go back to the pre-computed list and let's look at some well, this is interesting, but we already have, and this makes sense. This is the gold miners. Well, it's not a very good pattern anyway. So you can see it's just chopping around. The ADX is really low. But if we go back and put the Elliott wave pattern on there, the Elliott wave is suggesting a move to the upside, but it's not a diagonal. It's not even really a a well-formed corrective triangle, not unless it goes sideways for a bit longer. If it does, if it extends out, then you can make a case for a potential descending triangle. It just has got a ways to go before that becomes formed well enough to consider, in my opinion. I just thought it was interesting because we have the corrective triangles on GLD and on SLV, and SLV and GLD have had a couple down days, especially with SLV. Yesterday's move was boom. Now, what do we have today? Doji. Does that change tomorrow? It's going to be interesting, isn't it? Because that's a pretty tight doji. It was a small bars, an inside day. Again, meaning the high of today was lower than the high of yesterday. The low of today was higher than the low of yesterday. So it's an inside bar with a really nice doji, complete indecision on the metals today. So something is likely to happen in these positions tomorrow. So it'll be really interesting to see how they play out. So with that going on in the metals, that's the reason that I wanted to look at that JNUG VEEV systems. Not familiar. Not a bad pattern, just not a big enough triangle though. You see that there. Well, let's see what the options look like. It's bigger than I thought it was. The other wave pattern on there. Oh, well, that's only 24%. That's right at that fib level that normally implies a continuation. But boy, that ADX sure dove down on this consolidation, didn't it? Wow. Usually talk about how the ADX is a bit of a lagging indicator, where the two directional indicators are more responsive to shorter term moves. But man, that ADX is, we're out of here once we got this move to the upside, and it just tanked down. It's interesting, but the other wave pattern, just the other wave pattern is suggesting a break here. And the fact that it's the 23.6% fib level, I find interesting. But normally it's simply you trade the triangle, you don't pick a direction, period. And wow, not a whole lot of, there's some contracts for October, the spreads aren't that bad either. Really interesting. And then there's pretty decent open interest going out to December, which is where we would be looking. It's pretty expensive though. You got to go an awfully low delta to be able to stay within our risk management profile. But the stock can really move, so it's interesting. You can really extend this back here to where you can see resistance, broke above it. No, failed. So back to resistance. No, got above it again. Oh, held that time. So now it's support. So resistance, tried to break, couldn't hold it. And then finally broke above it and held a support towards the end of August, made a move up. Now we're testing the support level again. Those are all the things that are nice to see when you're looking at a triangle. And 260 to 340 points. Wow, you got to go awful low on the delta. I'm willing to go a little bit below that 25 level for some of these more high-flying stocks because they move enough to where you can get to the sweet spot on the delta curve quick enough to where we get right back into the maximum acceleration point. This one may just be a little bit too far, unless it was, a higher dollar stock that tended to move more. So it's interesting. It's another one let's just watch it, see what happens. But not one that qualifies quite enough to send out an alert. And then this one has been sitting here on our search results for several days. And it would be a much better pattern if it wasn't for this day here. It's an ADR's TL, I believe it's Chinese, China Education Company. But if you took that bar out that day, then you could really see a nice descending triangle, couldn't you? But that day kind of messes up the pattern. Otherwise, it would be really well formed. The ADX just kind of went, all right. But look where the ADX is now. This is the interesting part about this. So it's not the greatest pattern. We'll see what the Elliott wave triangle gives us here. Yeah, it's drawing pretty much the same exact thing. So that's good. The ADX is so low. That's where it becomes interesting. You don't see them. You don't see that ADX drop below 10 very often. You would normally think if it's below 10, this thing's been consolidating for 6 months, but it hasn't been. It's only been consolidating since the beginning of July. Let's put the Elliott wave pattern back on, but I don't really care what the directional pattern is. That's just more for curiosity. This is just going to be a traditional potential breakout pattern. 35% corrective level. It's really nice. Let me get my lines off so we can leave the Elliott wave on there. So the top, it's 12 points wide for $70 stock. It follows all the rules. See if there's any options here. Yeah. There's good liquidity and it's not super expensive. The issue is it doesn't have December, which is the ideal month right now. So November is fine. It's 59 days out. That's okay. It just needs to move, but you can get a really decent delta. The spread's not very wide. So that's going to be our case study consideration for this week. So 922 is going to be TAL triangle. I like that one. I like that. See what happens, but typically when you get, see, look what happened last time. So this is more the CCI rule, right, where you go back and look historically at the signals, but look what happened the last time we got there. So we went through here and we consolidated. It's not super unlike where we are now with a bit of a shallow type triangle. You can see that, and then look what happened. It exploded on the breakout. We're just looking for something similar to happen. Same thing that happened last time we got down this low on the ADX. I really like this one. This one sets up nice. So that's our case study consideration this week. Wow, I've been rambling on. Let's see if we can get a few questions in before. XLF and Apple. Yeah, the financial sector, I mean, that's interesting. I wanted to show you the dollar. Look at the dollar catching a bid here. Why? I think that this coincides with the displeasure maybe that the market had. Other than today, we've been in, we got just a touch oversold. The downward move in the market is more in line with what I was expecting. Remember, I said I was surprised these first couple of days were so volatile that I didn't think that the next corrective move was going to be anywhere near as severe as what happened here, that this was going to be a more orderly correction. And it's playing out that way now. It's just the first couple of days were like, whoa. It started quick and volatile, and now it's calmed down and a more orderly move. But it just seemed like the market was disappointed that the Fed didn't give more. Now they did say, we're going to continue to use all of our tools in our toolbox. We're going to continue to make asset purchases, but they weren't very specific in what they were going to do. And I think that left the market questioning, what really are they going to do? What are they thinking? Because they were pretty specific by saying they're not going to raise rates for 4 years. I don't know how you make a statement like that. Even in times like this, nobody knows what's going to happen 2 years from now. Hopefully, best case scenario, the virus is gone and the economy is doing really well and we're off and running. And, maybe the Federal Reserve at that point in time does consider, a couple bumps to raise the rates. But to come out and say we're not going to raise them for 4 years, I just think that's irresponsible. But just one man's opinion sitting here that doesn't matter. So anyway, this movement in the market here, I think, has been interesting as far as, here's the displeasure from the Fed meeting. That's what's happened since the Fed meeting. And the dollar catching a bit of a bid, I think goes along with that maybe the dollar was waiting to see, are they going to do another crazy thing like they did right when the virus first came out, where they just, boom, cut to zero and started buying everything in sight and threw trillions, literally trillions of dollars at the issue. Maybe they felt like, all right, well, they maybe not, or maybe aren't going to flood the market with as much liquidity as we once thought, and that's allowing the dollar to catch a little bit of a bid. I think that's pretty interesting, and so the financials are struggling with that a little bit. The alternative thing of there's no spread. It's tough for financials to make money when there's no spread. Where's the DMI? Yeah, it's too high, but it was a decent looking triangle before the past couple of days, but pretty much everything in financial has gone down the past couple of days. And Apple, remember we talked about this pesky gap here. Apple's going to move primarily with the market. It's pretty much the market bellwether with its standing in the S&P. So the market and Apple are going to look very similar as they do. And we came down, didn't quite fill that gap. 50% corrective move, logical point to bounce is where we hit yesterday. So very logical for that to bounce. That could hold. That could hold. We could move higher from here. We'll have to wait and see how that plays out. But man, if I was long Apple, I would have felt better. Let's come down to the 61.8% level. That's so strong. Fill this gap. I would have felt a lot more comfortable about going on. It may still bounce to the upside and run from here. It's got a decent area of support at the 50% corrective level, but I just would have. It would have been almost too perfect. Close this gap, hit the 61.8% level. Now we're all clear, all green lights to move forward. TLT. It's a nice triangle. This is a pretty nice triangle. The question is there a reason not to move forward with it? Well, we have our SEP parameters, and let me explain why the low ADX is an important indicator and why we place weight on that. Are there triangles that break out with an ADX above 13 or 15? All the time they do. However, there's the other side of the coin as well. I mean, there's a reason why that is part of the formula for looking at these triangles. And I've mentioned this previously, briefly, but in more detail. When you have a triangle formation, sometimes you get a false breakout where it looks like it's breaking one direction, get everybody that may be in a strangle type scenario to take one leg off, and then you get a reversal and the big move actually ends up being the opposite direction. Well, then you get patterns that look like, okay, we get a false breakout to the upside, then it comes down, and then it bounces from there. So it almost appears that it's two false breakouts. Well, you can't have two false breakouts. What's occurring there is a larger triangle formation is happening. When the ADX is really low, it's far less likely that that's going to happen. It still does happen. We still have positions even with a low ADX where the triangle it looks nice at the time, but it's just not done, and it forms a larger triangle. It's frustrating to wait for the breakout, but the breakout's usually awarded because when it forms a larger triangle, usually when it finally breaks out, it's a more volatile breakout. So the patience is usually rewarded. It's just frustrating at the time. So that's the reason why the ADX becomes valuable when we're looking at the triangles. But you're right. I mean, that's a great triangle pattern, and that may explode and break out. But then when you look at the DMI, it's at 20. So it's not even close to 15. And considering the fact that it's in the point of the triangle now, it may break out and move before the ADX moves down that low. But the pattern is good. And of course, there's really good liquidity. Not a surprise, just double checking. So that's the thinking. Events, look at the CCI on what? Which security are we talking about? Keys. Yeah, we just looked at GLD, so keys. Is that the stock symbol? KEYS. Trades on New York. 4-letter symbol. Well, hasn't been forming very long. But yeah, there's a decent triangle there. ADX is dipping down. That one might even trigger tomorrow. Or maybe on the list, we didn't even look at the full list. I guess we didn't look at GLD, did we? We looked at SLB. So I'll look at GLD. As far as the question, why didn't we send out MTOR as an alert? There was a reason, and back on the 1st of September, there was a reason, and to be honest with you, I don't 100% remember. I'd have to go back and do the analysis of it to try to figure out. There was one piece of why it didn't get sent out as an alert, but I don't remember what that was. I'll try to get that answer for you next week. But yeah, there's the GLD, and I still say you can draw this triangle two different ways. You can draw it as a descending triangle, or you can come all the way down here from this part of the move and make it more symmetrical looking. But I think the descending triangle is a bit more accurate. You have this vertical move. Remember, I really like the consolidations following a vertical move, and we're trying to break to the downside out of it here. Well, it's going to be really interesting to see if these metals continue to break down over the next couple of trading days. But now we have gaps. So are they going to fill the gaps first? Whatever. See, another example here. Look at this big gap down. Big, huge gap down. Boom, right back up, build it, and then back down. So that's why you hear me talking about them so often. I know you're probably tired of hearing me talk about gaps, but there's a reason for it. It matters. Take one more. We're over time, and then we'll wrap things up. Janice, the TAL chart was from, it was a combination of the consolidating stocks and the wave 4 buy. So let's finish with Tesla. Can't have a week go by where we don't look at Tesla. Is there anybody that doesn't trade this stock? It's amazing. But we're still forming that triangle. We talked about that last week of if it continued to form that triangle, it'd be really, really interesting. And I think it's probably way too expensive, but that is nice. That is a nicely formed triangle with the low right in this whole area of support. ADX is trying to get down there. It's not down far enough yet, but it's sure trying. This is probably another one where, and that's the thing, you know, when you're looking at the low ADX, maybe you miss some, but you're also not putting yourself into as many situations as the triangle becomes larger either. So it's both ways. Let's look at November because there's no way you can go out to December on this. Yeah. Impossible. The only thing you could do is, and we'll talk about this maybe next week. Let me just bring this up, and then I'm going to use this. I'll make a note of this. We'll lead off with this next week. This one will blow your minds. A double out the money butterfly. That's something that you can do when you have these high flying stocks. I've done it before. It works when you get it right. And there's just no way you could do anything with Tesla as far as trading the triangle for a breakout other than, I call it twin butterflies. Some people call them double out of the monies. I call them twin butterflies. But you place two out of the money butterflies. So I'll leave you with that thought. Thank you. Again, if I didn't get your question, I apologize. I ran a bit longer in the education part than I expected, but come back next week, ask your question, and hopefully I get it then. But I hope you found this informative. I thought that presented a lot of interesting things tonight, so I hope you thought so as well. Hope you have a wonderful week, and we'll be back to talk again next week. Take care, everybody.